What's going on, everybody? It's Stas here. So in this video, we're going to be doing an M1 Finance portfolio update, going over one of my long-term accounts here in the stock market, breaking down everything I own, stocks, ETFs, what have I been buying, have I been selling anything, and I also want to go over the dividends that I've been getting in this account. And we're obviously in very volatile times in the stock market. The election's coming up, stimulus, they're battling back and forth there, and the economy is still struggling. So I also want to break down where my head is at right now, my mindset as an investor, a long-term investor in the current stock market. So if you guys find value in the video, make sure to hit the like button for me, subscribe to the channel, and check out the playlist down below if you guys want to see where this portfolio started from $0 and how it got all the way to where it is today. Again, check out the playlist right down below in the description box. So without further ado, let's get right into it with the M1 Finance update here. And I think this is like the 27th episode in the series. Unbelievable, guys. We started this portfolio back in July of 2019. If I go to the All tab here, you guys can see it. Back in July 2019, we literally started at $100, and it's crazy how we've gotten here over the past about 15 months by depositing money, receiving dividends, and having the market appreciate as well. So overall, money weighted average returns about 14% here. And this is money weighted average, right? Yeah, money weighted return 14%. The gains about $360, 100 from dividends, 260 from market gains, and you guys can see the value of the portfolio right now is about $7,400. Last time I did an update about 3 weeks ago to a month ago, it was at about $6,800. I've deposited money since then. We've gotten some dividends since then, and we've gotten a little bit of price appreciation. So overall, again, up about 14% money weighted average return, but in the past week, we're down a little bit. Down about $200 market gain as the market's taken a hit here. In the past month, we're still up about $185. In the past quarter, we're up about $330. And in the past day, which was yesterday, we were down about $126 as the market took a pretty big hit. So at this point, guys, again, $7,400, and this is what the portfolio is looking like. I believe I have about, let's take a look here on the holdings tab, 21 positions in this portfolio. So let's break it down. First and foremost, I have DGRO. This is an iShares Core Dividend Growth ETF. The expense ratio is about 0.08%, which is extremely low when it comes down to expense ratios. A lot of the time you see some of these mutual funds with 1%, 2% to manage the fund. Well, with this one, it's only 0.08%. So it's literally pennies on the dollar. It's less than pennies on the dollar in terms of expense ratio. And this is mostly, it's a growth ETF, right? So there's a lot of tech in here. There's a lot of companies that pay a small dividend now, but they're growing the dividend aggressively to the point where in the future, there's going to be a lot more dividends paid out, right? So I hold this one. It's about 8% of my portfolio. The dividend yield is pretty solid despite it being a dividend growth ETF. It's about a 2.4% yield. So I like that, right? I like that. And that's the first holding here. The second one is good old Starbucks. This is one that I've been calling out on the channel for months, I feel like. It's been a while. I've been calling it out ever since the low 70s, mid 70s, and I told you guys, hey, listen, Starbucks, if the economy recovers, as we are pushing past this crisis, which we are trying to, we are obviously not past the crisis quite yet, but I was saying, as the economy recovers, I think Starbucks is going to do very well. And I put my money where my mouth is. My average share price is around $75, and we're doing well on the position, up about 20% overall. And Starbucks does pay a pretty decent dividend, about 1.8%. But honestly, guys, I'm not really in it for the dividend. Yeah, there is some dividend growth there, but I'm also just in it in general for the brand name and the growth of the business itself. I really like Starbucks, and that one's about 6% of my portfolio. And the next one here is Microsoft, MSFT. This is about 5% of my portfolio. I'm in at about $180. They pay about a 1% dividend there. And this is one that's really a no-brainer in my opinion. Although this isn't financial advice, I believe Microsoft has a position in anybody's portfolio out there, guys. And again, this is not financial advice. Do your own due diligence. That's just my personal opinion. And you'll notice, right, if you look down here at the target and the actual percentage of these positions in my account, they're all around 5 to 6%, with the DGRO ETF being the exception, being around 8%, right? So I'm nicely diversified here, about 5 to 7, 8% with all these positions. And at the bottom, I have some that are about 2, 3%. We'll get into that in a second. And yeah, Microsoft, under that we have J&J, which is a no-brainer as well in my opinion. I'm in this one at about $140. They pay about a 2.7% yield. They're also a dividend king, meaning they've paid dividends for 50 plus years. They've grown their dividend for 50 plus years. That is absolutely incredible. Then under that, under J&J, I have Google here, also known as Alphabet. I'm in this one at about $1,500. Pretty much break even on this one, guys. And this is one of the newer ones that I've added into the portfolio. I added this one about a month and a half ago, 2 months ago here. And then under that, I have ARK Innovation ETF, ticker symbol ARKK. And this is also one that I recently added in the past couple of months. And when I started this portfolio, right, and you guys should know this if you guys have been tracking along, this was originally supposed to be more of a dividend portfolio, more of, a little bit of dividend growth as well. But as the months have gone on, I've added more pure growth into it, right? Not necessarily dividends, right? And ARK fits that category. It doesn't pay a dividend, but it does 0.2%. But you really can't count that. I'm in it more for the growth, right? ARK is great for growth, especially if you want to just have a piece of the future. That's kind of how I'm looking at it, right? So I'm in a bit of ARKK here, about 5% of my portfolio. Under that, we have Amazon, also about 5%. That's another no-brainer. And under that, we have Pepsi, which is also 5%. This is more of a value play, a dividend play. It does not have a ton of growth, but it's more stable, right? It's a blue chip company. It's about a 3% dividend yield here. I'm in at about $133, and I feel very comfortable holding on to that. And under there, we have Disney, we have McDonald's, and we have Altria. 3 blue chip companies. Is Altria a blue chip company? I don't know if you'd put Altria in that category, but I like it either way. And Disney's actually one that is looking to pivot, right? They're looking to go more and double down into their streaming. I personally like that. I believe they might cut the dividend due to this, which I'm completely cool with. And you guys have to realize a dividend is a dollar amount paid to shareholders, right? And typically companies that are more mature and there's not much growth left, they pay a dividend because they can't reinvest that capital back into the business themselves and grow the business. And Disney is not really in that category. I feel like there is more growth left in them. So I would be cool with them completely cutting the dividend, reinvesting that back into the business to grow streaming, right? And to build the business higher and just create more internal growth and not give the dividend to me as a shareholder. I'm completely cool with that. So Disney, I like it. There's a lot of growth, in my opinion, there when it comes to streaming. And then under that, we have McDonald's and Altria. Like I said, those are, Altria is arguably blue chip, but McDonald's definitely is. McDonald's has a dividend of about 2%. Here, I'm in at about $198 per share. Altria has a very juicy dividend, about 8.5%. I'm in at about $41 per share on Altria here. And under Altria, we have Realty Income. This pays dividends monthly. It's a REIT, Real Estate Investment Trust here. I really like that. And under that, we have AbbVie, another high payer, about a 5.5% dividend. Let's take a look at Realty Income. It's about 5% as well. So you guys can get it, right? You guys get the point. There's a lot of mix in my portfolio. We have growth, we have dividend, we have some monthly payers, some quarterly payers, and companies that don't even pay dividends at all, right? And under AbbVie, I have MasterCard. Another growth company here, pays about a 0.5% dividend, so I'm not too worried about the dividend there. Quite honestly, I'm in it for the growth. And under MasterCard, we have Facebook, guys. Good old ticker symbol FB. I'm in this one at about $225 per share, up a little bit there on Facebook as of right now. And then under here, guys, we're starting to get to some of my smaller holdings, right? More in the 2 to 3 to 4% range. I have VE, which is a Vanguard FTSE Developed Markets ETF. This is actually an ETF that excludes America, the USA, right? It has companies that are international. This is a great way to diversify outside of the United States. I think that's very important. So I'm in this one, about 4% of the account, in at about, what is it, $41 per share, dividend yield of about 2%. So that's what I'm doing when it comes to VEA here. And then under that, we have Duke Energy, DUK. This is another dividend play. It's a utility company. It's about a 4% yield. I'm in this one at about $90 per share. Under that, we have PayPal. And it's funny, guys, PayPal is one that I've been buying since the 90s, 100s, 120s, 130s, and so forth. And this is one that has run up so much that I don't want to average up completely here. At about $200. I don't want to average up on it quite yet. So it's kind of fallen down in the portfolio since, quite honestly, I haven't added money to it because I think the price needs to come down a bit. That's just my personal opinion, but I'm still holding on to it. I'm viewing it as a hold right now. And then under that, we have another ARK ETF. This is the ARK Industrial Innovation ETF. It's about 3% of my portfolio. That's ticker symbol ARKQ. Under that, we have AT&T, and under that, we have Procter & Gamble, right? Both of them making about 2 to 3% of my portfolio individually, so collectively about 5% of my portfolio. So AT&T is one that's been clobbered up recently. It's at about $26 per share, so I might add a little bit there just to average down. This is more of a dividend play, about 8% of a dividend. And Procter & Gamble, I'm not looking to jump the gun quite yet. This one's close to all-time highs. The earnings are, I believe, this week, so we have to be careful there. And I'm already up a good amount. I mean, I'm in at about 116. The price right now is about 140, and they pay about a 2% dividend, so I'm not looking to jump in and average in quite yet, but again, like some other stocks in the portfolio, I'm just holding on and just riding it out because, again, this is not a trading account. I'm not getting in and out. This is a buy and hold type of account. So let me know in the comments, guys, what do you think about this portfolio? Do you have any thoughts? Do you have any, comments, whatever? Let me know down below in the comment section. Now, let's talk about what's been going on here. And quite honestly, guys, not much has been going on. I mean, if we filter through let's take out deposits, position changes. Let's just filter through trading and dividends only. You guys can see, I mean, the last time I bought stocks in this account was back on October 1st. I bought $306 worth of stocks from ARK Innovation ETF, Altria, Amazon, Google, Realty Income, AbbVie, and DGRO. And I really haven't done much since then other than just reinvesting dividends. And speaking of dividends, we've gotten $4 from DGRO. That's the end of September. We got $2 from Pepsi. We got another $6 from Altria. Again, a very high-paying dividend company there. And we just got a couple days ago $1.22 from Realty Income. And when it comes down to investing in times like this, guys, you may be asking yourself, Stas, are you not buying because of the election, the stimulus, and so forth? No, that's not true, quite honestly. I'm not looking to not buy because of the election. It's proven to be that just buying over time, regardless of the election, the economy, this, that, just averaging in over time has been the best way to go. So just because there's an election, there's controversy around stimulus, that does not mean that I'm not going to buy stocks. So at this point, I'm probably going to deposit about $500 in the next couple of days to buy more stocks, right? But I just haven't done it quite yet. Again, the last time I deposited money was back in the beginning of October. So that's really it at this point, guys. Nothing too crazy. It's really just a long journey when it comes down to, long-term investing. It's not the hottest thing. It's not the craziest thing. You just have to be diligent. You have to be persistent and just continue adding money and averaging into world-class companies that you guys think are going to do very well over the next 5 to 10 years. And that's kind of what I'm doing here. And I feel very comfortable with my holdings despite the craziness right now in the economy, the stimulus, the election, and just everything going on in the world right now. So there you have it, guys. That's the portfolio update for right now. Those are the holdings, what I've been buying. I really haven't sold anything, and the dividends that I've been receiving. So if you guys find value in the video, drop that, comment down below, let me know your thoughts. Make sure to hit the like button and subscribe to the channel. That's very important. And check out our free Strive Smart Discord chat and Strive Smart Facebook group down below in the description box. And if you guys want $10 free by opening up an M1 Finance account, I believe they're still running that promotion. Check out my link down below. All you have to do is literally sign up and deposit any amount, and you get a little $10 free for free, and it's pretty much just for long-term investors, right? M1 Finance. If you're a trader, don't use this, guys, because there's a trading window, right? You can only buy at one point in the day. So if you're a trader, you can't really pinpoint your buying. But if you're a long-term investor, I love this platform as kind of a set it and forget it. Just put money in, buy, and just leave it, right? That's kind of what the platform's meant for. So if you guys want that $10, again, it's linked right down below in the description box. So I'll catch you all in the next video. Thanks for watching. As always, stay safe out there, guys. Peace out.